I don't know, something which is cheap because it's rubbish, actually. Right, earnings calendars. Dollar Tree, Broadcom, Lululemon. They're not going to move the markets. They're probably going to just reassure the markets when they produce good earnings and returns. But I was just showing this to say there's nothing market moving at the moment. What we've seen with these is these little bubbles are percolating upwards. That will percolate upwards. We know that. I'll guarantee that's going to percolate upwards. I just won't guarantee over what time frame. Okay, that's going to percolate upwards. Wife and son are into those big ones. I am not yet into those in any big way. I've covered by them being in it. If you think of me, my wife and son was one big portfolio, then at least they're in, I'm out. 1 foot in, 1 foot out is what I'm saying. And that's a more optimal strategy. If you think my strategy should be, well, why can't you see the future and pick the exact bottom? Then you're wrong. I'm not that guy. Okay. Past week looked like this. Interesting. These are still expensive. One day I'll buy these again, but not at the moment. Don't read too much into the past week because we're not here to trade. We're here to invest. Okay. Past year, that's where we are with all of these, which isn't bad. Over the past year, this has been making a bucket load of profits, which have gone into its balance sheet. So P&L goes into balance sheet at the end of the year. Okay. And it's generated lots of cash. The cash went from the cash flow statement to the P&L, and that's going to end up in the balance sheet. On a balance sheet valuation, that's got cheaper because guess what? The price hasn't gone up in the past year. Pretty much. Same thing with this. Pretty much same thing with this. Definitely same thing with this. Interesting. Not so much with this. Okay. And pretty much with this. They've got cheaper. Does that mean they're guaranteed to go up? No. Would I want to put my wife and son into it? They're already in it. Wife and son are already. Why aren't I already in it? Well, they're exposed. You've seen there's some reasons to think the market's overvalued and things would fall. So I'd rather just, I don't want to go in with both feet at the moment. Okay. And I continue holding the JP Morgan and the Goldman Sachs from previous. We'll go through some of these other ones as well. I am not a newsletter tip sheeter going, better buy Cisco because I think now we're going to have this, or get into IBM right now because of this. I mean, I might say I like them, but that'll be based upon the rationality of value, growth, income, cash flow statement. Now, if I were to click here, you'd see which of these 10,000 companies tick all the criteria. And guess what? I think there's about 50 at the moment which tick all the boxes. In fact, let me just do that off screen. How many are there? 94. That's it. Oh, sometimes people say to me, why don't you talk about British companies? Okay, Wise is on that filter. Wise is on that filter. Okay, I'll tell you what else is. So there you go. Wise is on that filter. That's interesting because I like Wise actually. So anyway, interesting. I didn't know Wise was on it because I hadn't looked at it before this because we just had it all updated for our clients. Now, that's where we are with that. Year-to-date performance is where we are. Look at that. Unbelievable. And you might say, oh, no, but China, oh, but America's going to fail. America's about to blow up. That's fine. You don't have to look at American companies. I just gave you a UK one. We apply the same test to the UK. It's just that UK has far fewer companies. And if the bar's that higher, raised by the fact that there's a lot of entrants from the US trying to get into the portfolio, then guess what? The Brits get crowded out because they've only got 350 large companies for a start. And then you start getting into the small caps. Okay, and then into AIM and all the rest of it. So that's where we are. Now, price alone doesn't mean I'm going to go out and buy Uber. I still need to look at the data, not narrative. I mean, if I want to gamble and have fun, I'll go to Vegas and look at narratives for stocks as well. ETFs, for those of you who don't want to look at just, say, the US, there you go. There's some ETFs on emerging markets. Feel free, be my guest, go have a look at them. There's the Chinese ones, there's Asia Pacific. I'll look at India in a minute. I'm not buying it yet, but I wouldn't have a problem with it longer term. That's all I could say. I mean, I wouldn't buy it right now because I think still going a bit sideways. I think they're growing at 7.5%. People go, wow, that's amazing. They forget that they're targeting 10% growth per annum for themselves out of there. And you've got other ones. I'll do a separate webinar on ETFs. Where are we year to date on the markets? UK is up there year to date. Unusual for the UK ever to be beating the US. It won't last because it never does. Over the past year, NASDAQ 16%. Okay. I'm going to reset that poll, and I'm going to show you another one. Oh, before I get in on about that. Yeah, Rolls-Royce every single week. I'll tell you what I say. If it falls X, sell Y. Okay. Ride it. If it falls 5%, decide what Y is for you. 10%, 15%, 20%, 25%. Just decide what Y is for you based on your risk appetite. If you think I can see into the future, you're wrong. Now, if you've liked the stock so much, you might say, well, if it drops 50%, I'll sell 100% only then. Fine. But if you're very risk averse, you'll say if it drops 5%, I'll sell 25%. And then if it drops another 5, I'll sell another 25. You'll work those numbers out. That's a better way to avoid regret and more likely staying longer than saying, oh shit, what's the future hold? Because we don't know. Right? It'll stop you getting out too soon. It'll avoid regret. It'll mean you sleep better, and it'll avoid you doing an all or nothing, which would be stupid. Exit, sort of saying, well, I've got to sell all of it or go buy of it. No, there is no fill or kill order for retail clients. You don't have to buy or sell all of it. Okay, so very simple. There's your Rolls-Royce strategy right there. There's your entire playbook, regardless of what happens in the future. That's your entire Rolls-Royce playbook. Simple. Okay, and I could do it with my eyes closed. Total earnings, 15%. In the US stock market, 13% market cap has risen. That's good. Revenues have only gone up. Sales have gone up 6%. Now, one of the reasons why I think sales have only gone up 6%, but profits have gone up double that, is I think AI is improving productivity, margins, and so on. That's margin expansion is one key reason why that's happened. Another one is mass accountancy fraud, which I don't think is happening. Okay, so it's all very healthy. This is what, when I was doing Bloomberg TV, I'd look at and say to the viewers, I'd say, look, as long as earnings are rising faster than market cap, you're okay, and faster than revenues. When that wasn't happening with the dot-com boom, it was like, listen, guys, we're going to fall some stage off a cliff. Ride the bandwagon of momentum, but as soon as you see it falling off the cliff, get the hell off, like 2022, by looking at short and medium-term prices using the indicators that I showed earlier. Top gainers,